Hi guys, welcome to my YouTube channel. So before we get started, make sure to hit the like button, also subscribe to my channel. Today we will talk about building wealth with real estate, online opportunities. So make sure to watch the full video. There are many ways to make passive income from real estate. They range from low-cost, truly passive investments to more hands-on methods of generating income from real estate investments. With so many ways to collect passive income from the real estate sector, there are options for any budget and time commitment. Here's a brief look at some of the many ways to building wealth with real estate. Online opportunities. 1. Publicly traded real estate investment trusts, REITs. Real estate investment trusts, REITs, that trade publicly on stock market exchanges are traditionally the easiest and lowest cost way to invest in real estate to collect passive income. REITs must distribute 90% of their taxable net income to shareholders via dividends to maintain their tax-advantaged status with the IRS. That makes them a great source of income. REITs are also a low-cost investment since shares of most REITs trade for less than $100 each. They're passive investments because you don't need to do any work other than research and follow the investment. Public REITs are also highly liquid because you can buy and sell shares through a brokerage account any day the stock market is open. 2. REIT exchange-traded funds, ETFs. A great way for beginners to start generating passive income from real estate is through REIT ETFs. They hold a broad basket of REITs, which reduces the risk of losing income if a single investment cuts its dividend due to deteriorating market conditions. 3. REIT mutual funds. REIT mutual funds are a lot like REIT ETFs. They hold a basket of REITs, enabling investors to gain broad exposure to the sector. A manager actively manages the mutual fund, aiming to buy shares of the REITs they believe will deliver superior performance relative to a benchmark index. Because of that active management, REIT mutual funds often have a higher expense ratio than REIT ETFs. They also tend to have a higher minimum investment, typically around $2,500. Usually, you'll need to purchase a REIT mutual fund through a broker. 4. Non-traded REITs. Non-traded REITs don't trade on stock exchanges. Instead, investors purchase shares through a direct-to-consumer online portal such as Fundrise or RealtyMogul or through a financial advisor. Private real estate investments have historically offered a higher income yield than publicly traded REITs, and they're also less volatile. However, many private REITs have a higher minimum investment, $2,500 or more, and require a relationship with a financial advisor. Non-traded REITs are relatively illiquid investments, meaning you can't easily buy or sell shares. Many non-traded REIT sponsors only redeem shares once a quarter and set a limit on the amount of redemptions they'll complete. 5. Real estate syndications. Real estate syndications enable passive investments in commercial real estate. They allow an investor to become a limited partner in a single real estate asset, such as a multifamily property, office building, or self-storage facility, or a private equity real estate fund managed by a real estate sponsor. However, most real estate syndications are only open to accredited investors. An accredited investor must have a net worth of $1 million, excluding their primary home, or more than $200,000 of income. Further, they often have a minimum investment of more than $10,000. Syndication deals are also illiquid investments, often requiring long-term holding periods of 5 to 10 years. 6. Debt and debt-like investments backed by real estate. Real estate-backed debt can be another way to generate passive income from real estate. You're lending money to finance the purchase, renovation, redevelopment, or ground-up construction of a property. There are many options, including 7. House hacking. House hacking is a way to generate income from your current home. There are many forms of house hacking, including buying a duplex or fourplex and living in one unit while renting out the others. Renting a room in your home to a family member or college student, or converting a garage or basement into a small rental unit. House hacking provides rental income to help offset part or all of your living expenses. However, it's not entirely passive income. For example, you might need to fix something a renter broke, and it can be an invasion of privacy. House hacking can require a large upfront cost to purchase the investment property or make a space for renters, and it has some additional tax implications. 8. Short-term vacation rentals. Short-term vacation rentals are an increasingly popular way to generate passive real estate income. You buy a home or condo in a vacation destination and rent it out to leisure travelers. Web portals such as Airbnb, Airbnb 6.32%, make listing a property and finding renters easy. Short-term rentals tend to command higher rental rates than long-term rentals, making them a potentially lucrative source of income. As a bonus, you can use your vacation rental when it's vacant. However, short-term rentals aren't exactly passive since there's lots of work involved in managing a rental. A vacation rental is more like a hospitality business than a real estate investment. 9. Rental properties. Owning rental properties is another way to generate passive real estate income. Many people own condos or single-family homes that they rent to long-term tenants, 12 months or more, to generate relatively steady rental income. However, rental properties aren't entirely passive investments. You might get a 2 a.m. call to fix a broken toilet unless you hire a property manager. Further, the income can fluctuate from month to month depending on expenses, and you might not generate any passive income if there are a lot of unplanned costs. Finally, rental properties often require a significant upfront investment similar to short-term vacation rentals. 10. Ground leases. Ground leases enable you to generate passive income from owning land instead of a building. You own the land underneath a building that you lease to the building's owner. A ground lease generates predictable passive lease income and tends to be a very low-risk investment. Ground leases offer less income potential in exchange for the lower risk profile. They also have a relatively high upfront cost to purchase the land. What do you think of our video? Let me know in the comment section below. Also, subscribe to our channel before you go. Thanks for watching.